Hi, this is Chad. Welcome to the presentation, Saving Like the Wealthiest, Why and How to Create Your Own Private Vault Account. It's a European economic strategy that some Americans are already using to pay mortgages off sooner, finance vehicles, or fund business expenses in retirement. And to go into further detail about this, I brought on one of our great account specialists, Jane Schulz. Jane, are you there?
Yes. Hi, Chad. Thanks for having me on. Yes, this is a high yield savings account that gives you a loan while also paying you interest. And in about 10 minutes from now, I'm going to show you exactly how to do that, how to get a loan for a Tesla and earn interest on that loan at the same time. We've got to get through the first few pages here, so stick with me, but this is going to really get interesting. And this works for any car, not just a Tesla. Chad just likes Teslas.
Why do we put money in a bank? It's not a trick question. Why do we put money in a bank? Most of us just put money in a bank because we're used to it. But really, we're just keeping it there until we decide what to spend it on. We think of a bank's main function is loaning us money, and keeping it there until we spend it is the best place for it. But really, a bank is just a middleman because they use our deposits as liquid reserve collateral to go borrow credit lines from the federal bank, which they loan back out to borrowers, and then they keep a spread, in the same way a landlord has a mortgage but collects rent. Now let's look at some of the places people leave their money. Under their mattress. Well, cash is king. You do have easy access, but you don't have any security and you don't earn any interest. A checking account, you have easy access and it's transactional. A savings account, that's your security for a rainy day account, and you're earning a little, but probably not that much interest. There's an alternative to this, and that's what we're here to discuss today. 401ks and IRAs, high-powered savings accounts with some tax deferment that allows you to grow your savings until you pay the taxes later. And there's an alternative to this. Pensions, a payout for the future. Gold, and unless gold crashes, it is pretty secure, especially against inflation. Cryptocurrencies. They might be highly volatile, but they are easy to access. Stocks and bonds. Potentially volatile, and there might be some hefty fees attached when you get ready to sell some of that so you can access the cash. Holding accounts. Well, until you identify your next great investment, there's a much more beneficial account to keep your capital in so you can earn a little interest in the meantime. Real estate. A private vault account can create extra benefits if you're warehousing your money inside real estate. Many high net worth individuals are already using these strategies. Business assets, real estate, equipment. There's an alternative to add some extra value and security if you're doing this. And last, CDs and mutual funds. They have higher dividends, but you cannot access your money for a certain length of time. And there is an alternative, and we're about to get into it. So, what do you know about Austria? You know anything about Austria besides the fact it borders Germany and Arnold Schwarzenegger was born there? I didn't. Well, Austrians don't have the United States Social Security system to rely on when they get older, so they keep a portion of their savings inside their whole life insurance policies, and then they borrow against the cash value for their whole life. There is a very good possibility that the Terminator's grandmother had a cash value policy. I'll be back with my grandmother's cash value policy. I apologize for the bad Arnold Schwarzenegger impression. I couldn't resist. Well, here in America, the concept of using a whole life insurance policy as a savings account was created in the early 80s by a man named Nelson Nash, who was a student of Austrian economics. Now, to understand Nelson Nash, you have to understand that there are two types of life insurance. The first kind, you get hit by a bus and your family gets $500,000. But then there's that mysterious kind that you hear stories about where someone sold their policy, but they didn't get hit by a bus and somehow still got the $500,000. And we've all seen commercials of this guy, J.G. Wentworth. It's my money and I need it now. Why would he run commercials to buy your structured settlement? Well, he's buying a predictable cash flow. And cash flow generation, whether it's a piece of real estate, an oil well, or a whole life insurance policy, is not going to have the same value at the beginning as it will decades and decades later. Drilling the hole for the oil well is always more costly than maintaining the pumps.
Usually, the way to maximize a winning lottery ticket is through the cash flow. You can take the $477 million lump sum, $326 million after taxes, now, or you can get the big Powerball $768 million payout, which is $25.6 million a year over 30 years, and then borrow against it. After 18.6 years, the payout option surpasses the lump sum, and this guy missed out on 11.4 years of receiving $25.6 million a year.
This is actually a hedge against inflation. If you Google, "is cash king during inflation?" you will find, although inflation is low, you are losing purchasing power daily by holding cash. If long-term financial security is your goal, you might need to adopt your thinking when it comes to how you use cash and how you handle debt. Cash is not king. Power, leverage, and control of the cash flow is. You cannot save your way into $1 million, especially if your money is not in an account giving you compounding interest with a high yield. In 1988, you could buy 4 stamps for $1. 30 years later, in 2018, you could only buy 2 stamps for $1.
By now, most of us have seen this chart. You take a penny and you double it for 30 days. All of a sudden, after a month, you've got over $5.3 million. This is the compounding effect, and while the whole life policies won't have this much compounding power, if you're buying a term policy right now, you're just renting insurance. But what happens if you don't die? You don't get a refund. So if you have a whole life policy, by the time the compounding starts kicking in, that's when you're old enough to actually need the product. And you can see in this chart, not really much compounding goes on until about day 18. So after day 18, 19, 20, it starts doubling in the thousands, hundred thousands, all of a sudden millions. That's the time when you need it the most.
Something you might not have heard of is the rule of 72. It has to do with compounding interest and how long it takes for you to double your money by earning it. If the length of time and the interest rate equals 72, that's how long it will take to double your money. For instance, 10% interest for 7.2 years equals 72. If you get 7.2% interest on your money for 10 years, you'll double your money. 5% for 14.4 years, 3% interest for 24 years. You can shake this up any way you'd like as long as it's 72. That's how you can double your money.
Capital One will not pay you 5% compounded interest, but some of their cards can charge us up to, and maybe higher than, 25% compounded interest. And that's off credit lines they got borrowing against our savings. The real question should be, what's in your private vault account?
And we've made it. Congratulations. This is the part of the presentation you've been waiting for. We're going to buy a car inside of a whole life policy. To walk us through how this works when you're keeping your money in one, Jane, are you there?
Yes, a private vault account really is just like having a prepaid line of credit where you are the banker and the borrower. You can even write checks off of your account. This here is a colleague's client. The account holder made a car purchase. He paid over $30,000 for the vehicle, and he pulled it out of his whole life account. It took about a week from the time the policy was issued and the time he actually picked up the car, and the policy getting delivered was just 7 calendar days. He borrowed it out of his savings account inside the mutual company, and he ended up saving himself over $4,000 in interest payments while he was still earning interest on his savings. He's paying himself instead of a bank and earning higher dividends, and that really is what's known as arbitrage. This is where it gets to be a lot of fun here. We're going to borrow against the cash value of your account, but we're still going to earn interest on that account through the benefit of arbitrage. A common example of this is a landlord making a $1,000 mortgage payment and charging $1,500 in rent to his tenants. The amount between one cost and another is what we are interested in here. Buying a car with a bank loan is the same thing as investing in a depreciating asset. The vehicle is, of course, not going to be worth as much in 5 years from now as it is right now. The interest on that amount that you've paid for the vehicle is actually $34,000 for this instead of the $30,000 purchase price. You could have been earning that extra interest inside of your own savings account instead of paying it to the bank. And this is done through the power of arbitrage. This private vault account of yours appreciates in value as you make major purchases out of it, like vehicles, and you just pay it back over time. This is an example of a 44-year-old buying a $50,000 vehicle right now. This is what we were talking about at the beginning. We are going to transfer $62,500 from our bank savings account or wherever you are warehousing your money to the whole life account. Then we take a policy loan and buy the car. Over time, we pay interest on that loan while earning interest at the same time on a bigger amount at a higher rate. This might look confusing, but if you just pay attention to just these highlighted numbers, which is a cumulative premium, net cash value, and death benefit, it will all make sense. You get access to this money shortly after opening your account, unlike if you were to put your money inside a CD or mutual fund. With this account, you can access around 90% of it right off the bat because you are a member of the mutual company. Much like how a credit union has members, so do mutual insurance companies. That is really the big benefit of leaving savings inside these over CDs where you can't touch it for a while. As time goes on, the account holder will have access to much more than what they put in. But starting out, if you put in $62,500, you'll be able to access around $50,000. So the account holder withdraws the $50,000 or the maximum cash value limit and purchases the vehicle. At that point, you would have a loan from the life insurance policy that has an interest rate between 1% and 4%. At the same time, you're paying back that loan. The account with $62,500 in it might be appreciating at a 6% rate, and with arbitrage might now be net earnings a few percent interest. Over the first 5 years, the policyholder puts in $137,502, and throughout those 5 years has access up to $129,459 of that, which is almost as much as was put in. If you were to close the savings account down, you would not get as much as what you put in. But why would you close the savings account down? Look at what happens in another 5 years to your savings. That is when it starts to get fun. After about year 10, you have saved around $205,000, but your account has earned over $15,000, over 7.5% interest, or about 0.7% average for the first 10 years, which is still better than a bank savings account. But over the second decade of the account, when you are 15 to 20 years older and probably need it more, it will be there for you in a big way. This illustration shows an account after 20 years of only saving $333,666. It is now worth $477,317. That is done through the power of compounding interest and the beauty of arbitrage. And as an extra bonus, the whole time there is a death benefit. So if the account owner ever gets hit by a bus or any other untimely passing, their family or heirs gets over $1 million. At age 65, $1 million term policy costs much more than the $1,250 a month you are putting in as savings. And that is why term insurance is bad over time, because you don't get a refund if you outlive the policy. And it gets more expensive every day as you get older. The borrower saves $1,250 a month after transferring their original $62,500 and takes the $50,000 out. At that point, the $62,500 starts a lifelong cash flow that a dividend starts working off of. Then it becomes a high yield savings account. In this case, $15,000 a year or $1,250 a month goes into savings. It's better than putting it into a savings account with a big bank where they only potentially give you approximately 0.03% interest per year. In this example, we transferred $30,000 out of a savings account at a big bank, earning basically zero interest. Once the account is open, you can start paying monthly mortgages and car loans from it. In this example, repeating the cycle of continually saving $5,000 a month inside the account, borrowing out of it for your expenses, and paying policy loans back allows compounded interest and arbitrage to work for you. After 30 years, when the account owner is, say, 75 years old, you've saved almost $1.8 million, but have a net cash value of over $3 million to draw off of. And that is with a $4.6 million death benefit to your family and heirs if you unfortunately pass on at that age. So why would you waste money on a term life insurance policy when you can put all of it together on this policy? There are no early withdrawal penalties, which is amazing. Loans from dividends and premiums are tax exempt because at the end of the day, this is a life insurance policy. 401k loans do not receive the arbitrage dividends, and deferring the taxes make the government your business partner. Where and how you save your money now and at this present time affects your future very directly. If you are a business owner, you should have at least 3 or 4 of these, and they are great for employees' retirement accounts. Ray Kroc ran McDonald's real estate holdings through these. Walt Disney ran the cash flow from the happiest place on earth through a life policy. J.C. Penney ran portions of his business expenses out of these same.
That was great, Jane. Thanks.
But don't worry, you don't have to be a titan of industry or super wealthy person to take advantage of these programs. If you're a small business owner and you're innovative, we can design one of these policies to help run all of your assets and capital through. If you're the head of a household, these are still great. If you lease equipment or vehicles, these are perfect.
If you were putting money into something each month that was eventually going to fail, when would you want to know? Probably as soon as possible, right? Well, a well-designed whole life policy is like having a crystal ball for picking a consistent place to warehouse and grow your money. The insurance factor eliminates the risk of loss. Now, this is an example of high risk. On May 15th, 1997, Amazon's IPO launched at $17 a share. If you would have bought $10,000 worth then, 23 years later, that $10,000 would be worth more than $12 million. Now, if you take a look at Amazon's stock price over the last 25 years or so, you notice that ever since the late 90s, up until about 2010, kind of stays at about the same price. So just think you're putting money into that for over a decade, not really getting any returns, and then all of a sudden you hit stride. And around 2013, all that compounding takes effect and your exponential curve launches. Now, a whole life policy isn't going to have that much of an aggressive curve, but while we don't know what the value of a company is going to be in the next 25 years, Where's the next Amazon? We know exactly how much the growth curve on a whole life policy will be. Right now, many more Americans are finally catching on about these cash value policy techniques. 60% of Americans do have some form of life insurance, with 24% of Americans having whole life insurance. Now, out of that, 84% are using the insurance for burial and final expenses. So we're not there yet, but around half of the people with the whole life policies are using them to help pay off their mortgages or supplement their retirement income. You can put as much or as little into the life policy or the savings aspect. You can put 50% into the savings and 50% into the life insurance. You can put 90% into the savings and 10% into the life insurance. But one thing's for sure, whole life policies are not a one-size-fits-all, and you really need a specialist that understands your unique individual need in order to have one set up properly. And when your time comes, it is easier to pass the wealth on to the next generation without probate or taxes. This basically becomes a pre-engineered trust. The death benefit pays out and your savings blossom. It transfers without probate or inheritance taxes. It transfers tax-free to your heirs because it allows them to be independent without reliance on government assistance. Again, why do we put money in a bank? When is the last time you've been to a bank branch? Banks are primarily transactional for the most of us these days. More and more millennials will eventually stop putting their money into savings accounts at banks over time. So is it more important to have a lifelong relationship with a bank or an insurance company? Well, to answer that, let's look at it from a 11-year-old Chad Mitchell perspective. We've got this strapping young lad with two really big front teeth. He's mowing yards in the hot Texas summer heat. He's making about $40 a week mowing 2 yards. $20 a yard? Come on, Dad. You could have done better than that. Well, I used to think it was really cool when I'd put $100 in my savings account and I'd earn $2 in a dividend. It was really cool as an 11-year-old to make 2% on my money. But as an adult, not so much. My mom actually opened my account for me because she was a teller at a bank at the time. And back then, the fees were not even close to what they are today. That's why we shut the account down. Today, a bank will fee you to death. They've got monthly fees without high balances. If you don't keep a minimum balance, they're going to charge you. If you take a bank loan from them, they're going to charge you a real high interest rate and not pay you a compound interest. Fees after passing withdrawal limits. Restrictions on withdrawal methods. Many banks pay less than 1% a year in interest dividends on money left in their savings accounts, even though they borrow against it and sometimes earn double-digit returns. We pulled the pricing for savings accounts off of big bank's website, and they're paying 0.03% interest to their account holders, but they're charging them a $8 monthly service fee unless they keep a $500 minimum balance. And if you withdraw more than 6 times a month out of this account, you pay $10 per withdrawal. And since inflation is usually over 2% each year, the value of your dollar continues to shrink, leaving it in a bank's savings account. You just don't really get the benefit of leaving your money in a savings account anymore. So why do we keep leaving all of our money in a bank? A bank is not our friend. We're just used to it, and we don't know other alternatives exist. This is basically a lifelong account you can live your entire life out of. You don't have to put your entire life savings into one to start, and you can have multiple accounts also. While we can't go back to when we were 11 years old and start one for ourselves, we can start one for someone younger as a small college fund or general life expense account, and I'm pretty sure they'll thank you later. These policies really have a lot of different capabilities. It just depends on what your individual needs are. And here to go through it a little bit more again is Jane. Jane?
Yes, you're right, Chad. These can be set to fit almost any individual household need. Family, expenses, property taxes, instead of paying impounds each month. Perhaps you pay it through your life insurance policy. Why give the government a free loan, right? We've already discussed how you can buy a vehicle through this, and you definitely can finance your vacations through this as well. It's just a big lifelong piggy bank with more benefits than a savings account at a bank could ever match. To prove this, we've done a 20-year comparison of a private vault savings account and a bank savings account. The private vault account outperforms the bank savings, and it's not even close. Let's find out right now and take the $1,000 challenge, a savings account versus a private vault account over 20 years. If we were to put $1,000 into a savings account today and then put $200 in it per month for 20 years, earning a simple interest of, say, 0.03%, which is just what they were advertising. After 20 years, you will have saved up $49,000, just shy of 50 grand, and your money will be worth $49,149.68. So you leave $49,000 of your money in a bank for 2 decades while they borrow from the federal government's bank. They do it many times over and over and make money on your deposits, and you're letting them do it. They give you only $149.68 in interest, which is probably not the best place to leave your money for 2 decades, especially when that $49,000 will probably have the buying power of $30,000 at the time because of potential future inflation. Now, this is what that account might have looked like if Chad started one for himself a few decades ago. $1,000 into a whole life policy account, then saving $200 every month thereafter. After 10 years, you're not really putting in $200 each month. And eventually, years 16 and on, you're only around $550 of your own money in each month because the dividends from the compounding interest you're earning are making those monthly savings payments for you. So in the end of all this, you put into savings from your own pocket a little over $39,000, but the cash value of that policy is just under $55,000. And the whole time you also have a death benefit. So if you get hit by a bus, this mutual company pays your heirs just under $200,000. A bank doesn't even give you a term life for free. Banking your money inside this mutual insurance account not only gives you respectable interest dividends like a high yield savings account, it also gives you whole life insurance. When the final numbers on the comparison are examined, we determined that putting your money into this account would have earned just under 40% on your money. There are many things that you can do inside these policies. You can finance vehicles, you can finance real estate, property taxes, and start a fund to pay for future tuition. You can finance your business inventory and procurement needs. You can also finance your assets and business equipment. All of this can be done through these policies. And that's it. That's the presentation. Saving like the wealthiest. What we need to do now is find out what your short and long-term savings goals look like inside the private vault account based on what you're trying to accomplish. You can either schedule an appointment, call, or text me for your quick 5-minute follow-up consultation.